Okay, well, great. Well, we'll start right now. And again, I mentioned this earlier. I'm so impressed with this academy and Dave, what you've done here, and the members. And I've been fortunate. My name's Steve Scoggan. I'm with CLA, and this is my associate Jeff, who will introduce himself in a minute. But we've been members, like I said, maybe Dave, 12, 14 years, something like that, a little bit before you arrived. And this is very impressive. And the plumbing industry, the construction industry in general has the same problem that the accounting industry has, in that we can't get enough people to do the work and enough good people to do the work. And so we're constantly looking for new folks. It would be great if we had something like this to set up for accountants and CPAs to learn new things. But this is just great what you've done, Dave, and you members and everyone should be very proud of this organization. But so to get into the presentation today, my name's Steve Scoggan. I'm a principal with CLA, it's a CPA firm, and I tell you a little bit about that. We're the 8th largest CPA firm in the country, and that might not mean much to you, but basically what it means to our clients is we have a huge amount of expertise that we can draw on. Some other things, were the biggest, I think still, the biggest CPA firm in the construction industry. I've been doing construction my whole career, and so with 120 offices CLA has, of which the Salt Lake office is one of them. And we're proud to be a part of that organization and serve the construction industry. And you want to say hi?
Yeah, thanks for having us here. As Steve mentioned, my name's Jeff Walker. Steve and I worked together for 8 or 9 years now. I also primarily focus just on contractors and a lot of plumbing and HVAC mechanical contractors that we work with throughout the year, and happy to be here.
Right. Sorry, we have to pass the microphone back and forth. So here's a little bit about what we're going to talk about today. Taxes, everyone's favorite subject. You're probably thinking about taxes right now as you prepare for this filing season. We're going to talk a little bit about some new stuff, some old stuff, some things that are expiring that people need to be aware of tax-wise to plan, not just for this year or next year, but for the years afterwards. So we'll talk a little bit about that. Jeff's going to get into some construction accounting issues and some ideas there. Also, we're going to share with you today the wage and benefit survey, or salary and benefit survey, that our firm sponsors along with AGC. It came out was it in November? It's in November. The actual survey was in September. I think it came out in November. But we're going to share that with you and invite you, if you're interested in getting a copy of that survey, which is very comprehensive. And I think we had about 85 Utah contractors that participated. This is just a Utah survey with maybe 40 or 50 different job classifications that are covered by that survey, and we're going to talk a little bit about that. But again, if you're interested in a copy, email either me or Jeff, and we can send you one of those. Many of the members did participate already, but if you didn't, we'd love to have you participate in the future and send you a copy. So we'll talk a little bit about that and some of the things that implies. Again, I know we all know that we need plumbers, we need construction folks in this industry, and we're all looking for them. But we can kind of talk about some of the things that the survey showed. And then any questions or comments, I don't know, Dave, if people can ask questions or not. If you have questions, jot them down and you can email us or let us know, and we'll be glad to answer any questions as we go through the presentation. All right, well, this is just a chart to kind of break the ice with construction activity here in Utah. It's kind of interesting how we have this bubble in the COVID years, which was kind of interesting. Many areas of the country were just the opposite. but we continued to have a strong construction cycle here. And as you can see, we're almost back to where we were pre-COVID, a little bit less. But again, the different colors there, obviously the biggest, the light blue is residential, and that has stayed fairly constant. I'm a little surprised that it didn't drop. I mean, that 2024 is a projection, but I'm a little surprised that residential didn't drop more, but apparently it didn't. So they just kind of to set the tone, you know, I think we're all very fortunate to be here in Utah and in the construction business, because this place doesn't seem to miss a beat. And, you know, yeah, it was tough back in 2008, 2009. I was there. It was very difficult, but then we recovered very quickly. So we're just really lucky to be here. And I don't see any end in sight. I mean, we talk to clients all the time about, you know, well, gosh, what do you have in your queue? What kind of jobs are you bidding? Are there a lot of things still out there, projects you're hearing about, work that you're doing now? And everybody, for the most part, seems to be busy, right? And it's not slowing down. So again, we're very fortunate to be here in Utah. So taxes, all right. Well, as the slide mentions, taxes are one of the biggest line items if you're making money, along with whatever materials, labor, overhead, things like that. Taxes are a big chunk of that. And if you're profitable, you're paying a lot of taxes. And there's nothing wrong with that, but hopefully you're in the mindset of paying attention to different ideas and planning concepts that might help you maybe not do away with your taxes, but maybe postpone them or push them down the road. So we'll talk a little bit about some of those things. There really are only a few big ways to reduce or postpone taxes. And everybody's, I'm sure, knows about depreciation. You know, construction, that's what they're known for. You buy stuff and you deduct it mostly in the year that you buy it. Kind of a no-brainer. But pension and profit sharing plans, not everybody takes advantage of this. There are many different types of these, you know, obviously from a 401k or a SEP plan or something very simple like that to, you know, defined benefit plans and considerably more complex planning, profit sharing plans. But it can really give you a big opportunity to postpone taxes until your retirement or your employee's retirement. We like to try and gauge things and emphasize things towards the owner of the company and get as much money as possible to them. But so a lot of opportunities there. Tax methods, you know, many of our contractors have different tax methods. Everybody's heard of the cash basis, right? And, you know, the rules changed a number of years ago that allowed bigger contractors to be able to be on the cash basis. But there are other methods that are even better for certain contractors, depending on their work and whether they're growing and things like that, to be able to postpone taxes and, you know, pay later rather than now. We'll talk about some tax credits and incentives. One of the most important things, and Jeff, you'll probably second this, that the clients that we have in the construction industry, namely, have good accounting records. They're able to know where they're at. They're able to close their books in a timely fashion so that they can do planning. I mean, if you don't have good numbers, it's difficult to plan and you know, make moves to save or postpone taxes. Let's see. And then, yeah, this is what we do with our clients is we get with them regularly. And if you're not getting with your tax or accounting person, CPA, regularly, well, maybe you should, because again, how can they help you if they don't know what's going on with you? And so we just highly emphasize a number of meetings per year, just to kind of keep keep our thumb on the pulse beat of your company and how we can help you save money. Okay, depreciation. Well, everybody knows they buy equipment, they take bonus or Section 179 depreciation and they deduct it. Okay, everybody knows about that. But most contractors that I work with, have some real estate also. And real estate is a great investment for the future, but it's not a real great tax play. And you can't generally get a lot of tax deductions for real estate. Residential or non-residential commercial property is 39 years. So you have $1 million building, you're depreciating, $25,000 a year for 39 years. Not a great tax play. However, there are some ideas, and one thing I'll mention to you, and I've mentioned it to this group before, is a cost segregation study. And that's basically where an engineer goes in and analyzes the building and the details and the components of the building. And like, for example, electrical, we got all these things plugged in here. All this property that's plugged into the wall is 5-year depreciation life. Okay, well, the IRS says that you can not only depreciate this piece of equipment for 5 years, but you can depreciate all the electrical in the whole building, okay, that goes into that because it's connected to a 5-year asset. So basically what a cost segregation study does is it breaks out shorter life assets from the building. And typically, for example, like I said, that $1 million building would get $25,000 a year in depreciation. Well, what a cost segregation study would do would go in and break out a portion, and typically it's about 30% of the cost of the building is broken into shorter lives. So for that example, 300,000 of the $1 million would be 5 or 7 or 15-year property, not 39-year property. So what that means is you can accelerate your depreciation. I mean, in that example, I think if you average that 300,000 over 7 years, that would increase your depreciation from $25,000 for that building per year to $60,000. Which will save you, just for this example, 10 grand in taxes for doing this. And it'll save you 10 grand in taxes for the next 7 years. Now, when you get to the 8th year, it's going to catch up. I mean, you're not making this go away forever, but you're front loading the depreciation to be able to save taxes up front. So an idea for you. Pension and profit sharing plans. Well, okay, tricycle, bicycle, skateboard, a motorcycle, and sports car. Okay, well, that's just attempting to illustrate the levels of these different types of profit sharing plans. An IRA, everybody's heard about that. You can do that as an individual, but you can only get a deduction of $6,000 to $7,000. Not a very powerful tax planning. A SEP, self-employed pension plan, you can get up to $66,000 put away for people. Same with a 401k, a little bit less, and each one of these has its own restrictions and different things that you have to plan for. A profit sharing plan, which is probably the most common that we recommend to our clients, owners can put away $66,000 a year, a pretty big chunk. And profit sharing plans do give you the opportunity to discriminate a little bit, whereas some of these earlier ones, the IRA or the SEP and the 401k, you have to do the same thing for every employee that you have, including you, the owner. But with the profit sharing plan, you can discriminate a little bit, get a higher percentage to the owners and the key people than the rank and file. Just, again, something to talk about. Defined benefit and cash balance plan, those are even more complex, but you can get, we've got a number of these with our clients, and the owners are getting up to $275,000 tax deductible in the current year set aside for their retirement. And again, there's a chance or a way to discriminate so that you don't have to pay that's the same percentage into the plan for the other employees other than the owner. So again, something for you to explore. Whoops, here we go. Tax accounting method changes. The law changed in 2017, into 2018, when it used to be that the only cash basis. Cash basis is a great way, for the most part, to postpone taxes and to plan, because it's basically how much money did you collect and how much did you pay out during the year. That's what you pay your taxes on. I mean, most of you are keeping your books on the accrual basis, percentage complete for construction, and that's different than the cash basis. The cash basis can be manipulated a little bit or planned for, where you can end up having lesser taxable income than you do your book income. So again, whoops, a plan there. But they changed the law in 2018. It used to be if you were under $10 million in revenues, you could be on the cash basis. If you were over 10 million, you couldn't be. You had to be on the accrual basis. Well, that changed, and it changed to 25 million, and now it's grown with inflation. But it's basically, if you're under $29 million in revenue, you can still be on the cash basis, okay? And then that also applies to some other methods for contractors that we help our clients with. The completed contract method, which is basically where you don't pay taxes until the job is complete. You pick up all the profit on that job the year that it's complete. And then other methods, there's residential, different types of deferral methods, depending on the type of work that you do. So again, it's something that you might want to investigate. I mean, probably most small contractors, small, medium contractors are on the cash basis, just in general. But maybe there's some other options that you might have that might make more sense for you. Employee retention credit. Oh boy, let's talk about that. It expired at the end of January. The IRS has been struggling with this. All of us have been struggling with this. This has been one of the more challenging things in my career in terms of dealing with the IRS and the rules and the changes, and it's just been crazy. So it expired, so you can no longer apply for it. Many of you did, and there's an option now and it's good, for another week and a half, you can pay back 80% of what you received if you believe that you didn't really qualify, which many people didn't. They were sold a product from someone who happened to call you on the phone and say, hey, gosh, it sounds like you qualify for this. And you got a bunch of money and you were happy, but it's the IRS is going to be all over this. They have a 5-year audit window, and basically that's from the end of 2021. So they can audit you through 2026 for this. And the IRS hired a number of agents, tens of thousands of them, and I believe we've heard that many of those agents are going to focus completely on the ERC. So I do recommend this 80% payback. I've got a number of clients that are using this opportunity. Basically, you can pay back 80% of it and keep 20% of what you received, and you pay no taxes on that 20%. And it's a done deal. They're not going to audit you. It's done. Because one of the other issues is, if you did receive the ERC, you need to pay taxes on it, on the full amount, both federal and state. And so you need to have your accountant go back and amend your 2020 or 2021 return, whichever year that the credit applied to, and pay taxes on that. So many people don't know that either. So but if you do the 80% deal and you keep the 20%, you don't have to pay taxes on it. If you've already amended your return and paid taxes on the full amount, you can amend that return again and get that money back. So again, this is the most messed up thing I've ever dealt with with the IRS and the rules and trying to keep up with this. All I can tell you is beware. There's a really good chance that you're going to get audited, and we don't know the scope of that, but I think what they're going to ask you is they're going to send you a letter and say, hi, we saw that you got the ERC. Please send us your support for your qualifying, as well as some of the backup for the employees that you claimed and all of that. But they're going to ask you specifically for how you qualified. And if you don't have that, and many of the outfits that were sweeping through the valley here and calling people owners don't have any support for their qualification. They just said, oh yeah, did you have supply chain issues? Yes. Well, that's not a good enough reason to qualify. So, okay. And then expiring, just to let you know, there are a number of things that are expiring here soon in 2025. That qualified business income deduction. If you'll remember, this was another thing that came out in 2018 where flow-through entities, which most of you are, took a 20% deduction just right off the top of your taxable income. You have $100,000 in taxable income, you have a $20,000 qualified business income deduction. So that is going away in 2025. So that's a big deal. 20%. You're paying 20. You've got a 20% haircut on your taxes since 2018. That's going to go away, unless, depending on what happens here in the political arena over the next couple of years, maybe they'll reinstate it. But big deal. So pay attention to that, and that might mean you want to pick up or push more income into 24 and 25, and then prepare for 26 having less taxable income, because again, this deduction's going away. The state tax deduction workaround, well, it's called pass-through entity tax, and hopefully you're aware of that, where one of the things that came out of this 2018 tax bill that had that qualified business income is that you could not deduct on your personal return more than $10,000 in state taxes. So therefore, I mean, I've got clients that pay hundreds of thousands of dollars in state taxes, and they can only deduct $10,000, and that was restricted. And so that still applies. However, a lot of states, and Utah's one of them, decided to say, okay, there's a workaround. We're going to now give you the opportunity, Mr. Business Owner, Mr. and Ms. Business Owner, to, if you pay more than $10,000 worth of state taxes, you can deduct those taxes through the company, therefore reducing the federal tax, the tax on your K-1. It gives you a chance to deduct that. So basically, you have to prepay the taxes like you used to do back in the day. We would have you pay your Utah taxes before the end of the year, because that way you can deduct it. Well, it's the same thing with this pass-through entity tax. So again, an important thing, and hopefully you all took advantage of that over the last couple of years. Tax rates will increase to 2017 levels at the end of 25. It's not a big deal, but it's a couple of percent for the highest tax brackets. The estate tax lifetime exemption is decreasing significantly. So right now, the lifetime exemption is like 12-point-something million per person. It's going to go down to 3 or 4 per person. So if your estate is worth more than that, you should be planning very diligently to figure out ways to get stuff out of your estate, because that lifetime exemption is going to drop. Work opportunity credit, this is a credit that some of our contractors use, where if you hire people in disadvantaged situations, you get a tax credit. Again, you can call us and talk about that, but that is going away at the end of 2025 also. Okay, Jeff, finally.
All right, if you're not asleep already, I'll get you there in the next few slides. No. So a couple accounting topics. Honestly, this last year and 2024, we kind of get a break after many years of dealing with new revenue recognition rules, new lease standard, or we're kind of, when I was thinking of what could be applicable, there really isn't major changes to the accounting standards that are going to impact contractors. But I did want to revisit leases a little bit because that has been coming up with our customers a lot. Just making sure they're doing it right and showing it right for on their financial statements, for management decisions, as well as third parties that might be using that information. And so the new lease standard was adopted, should have been adopted January 1st, 2022. And so your 2022 financial statements should have reflected this in 2023, but we have been finding that many, not just contractors, but many of our clients have been missing a few things. So just wanted to touch on a few points there. So the new standard, what it really did at a high level, before, if you leased out a building and you paid rent, you would pay the rent and you would recognize an expense. And this is long-term. Any leases over 12 months. So short-term leases don't necessarily apply to what I'm saying. But if you have a 5-year building lease, or 3 or 4 year vehicle leases, this does apply. And so the new standard now requires it to basically be reflected as if you are financing that piece, that asset, and you would need to recognize, based off of present value calculations, an asset on the books, even though you technically don't own that asset. It's called a right of use asset, and a lease liability on your balance sheet. The accounting for this can be simple, but it also can be very complex. And so if you have questions on this or issues, feel free to reach out. But what it is doing is it's helping. I better be careful what I say here. I don't love the standard. I think that the users could get what they needed in the footnotes of the financial statements, but they thought it was applicable to help users really see what liabilities are out there for a company, to see what obligations they have coming up in the next year and in future years. That's really why they did it. So getting away from the actual accounting of it, many conversations over the last year about, well, should I be leasing vehicles? Should I be financing them, getting loans, or should I pay cash? And just like any complex thing, the answer is it depends on your situation. And just wanted to bring up a few conversations and scenarios where what you should be thinking about in this scenario. Leasing and financing is always going to cost more, just because of the interest piece of that. But depending on your cash situation, maybe you're in a good situation and can go buy, assets with cash up front. Always have to think about time value of money and what you could be doing with that cash that could be earning you more than the interest you might be paying if you were leasing or financing them. And so a couple other situations to think about is looking at your fleet. I know that plumbers don't have big excavators and large pieces of equipment, but you probably have quite a few trucks and vans and things like that. And so, is your fleet getting old? Are you paying a bunch of repairs and maintenance, or is it a big hassle to maintain them and track them? If it is, then maybe you do look into starting to lease and having an enterprise or somebody like that manage your fleet for you. So there's just a couple things to think about for that, and if you have other questions, let us know. So the other big piece of accounting always for contractors is the job schedule and how revenue is recognized. And Steve mentioned, depending on how much revenue you are bringing in each year could depend on how you're taxed for that. So if you're smaller and doing less than 29-30 million a year, then your cash basis can be a cash basis taxpayer. Well, accounting doesn't really have that flexibility as much. Percentage of completion is the most accepted method of tracking and recording revenue in the construction industry. Now, if you don't have third parties looking at your financial statements, you probably are just tracking things on a cash basis, and for now that might be okay. But as you grow, as you need additional financing, potentially bonding, as you get into the public sector, or a lot of general contractors that we talk to are starting to want their subs to have a compiled or reviewed financial statement. And so as you look into the future, where you want to be, the planning starts now to figure out to get your books in place, so there's not big issues when you do get to that point. So just wanted to spend a couple minutes. I hope everyone has seen or has something in place similar to this in-house. It doesn't have to look exactly like this, but it can be referred to as a WIP schedule, job schedule. Really what it's doing is it's breaking out your jobs and being able to look at how they're performing, how much revenue is getting recognized, costs going into it, so that you can see as the job progresses, not just at the end, did we make any money? Do we have cash in our account? That's not a great way to make business decisions, but be able to see as the job goes, what are some issues, where are we overrunning on costs, maybe even look, okay, there's a pattern here. This team has a history of lost jobs, and be able to work with them on training and things like that. And so if you don't have something like this in place, it's pretty simple. The most common input method to calculate percent complete is cost to cost method, where you're taking by job your total estimated costs and then tracking your costs to date, and then that would give you your percent complete. And then from there, you take that percent and times it by your contract value, and that should give you your revenue that should be recognized up to that point in time. Again, we don't have a room of CFOs and controllers here. I would go into more detail if we are, but there's something to go back to your accounting teams and maybe discuss and see if you're in a good spot here to make sure you're tracking your jobs properly. Anything you want to add there?
Yeah. I mean, many times contractors struggle with this. There's no question. We deal with a lot of contractors, and many of them, regardless of their size, really struggle with this job schedule. And part of what we try and do is we don't just go into a dark room and fix your job schedule and give it back to you. We try and train you as to how this thing works. And once you get it, or your financial people get it, it's like, whoa, the light comes on, and it can really, really, really help your business.
One of the sayings we hear all the time as we talk to owners of construction companies and ask, how do you know if you're doing well on a job if you don't have, the data there? And I love it, and I hate the response is, it's my gut. And it's true. There's a lot of things that, you just know, you've done it for years and years and years, and you can rely on that gut feeling and that. But combining that with data can make it even better, and you can make more money. You can be set up for the future better. You can bid better and have more success rate in winning bids because you have accurate data of historical jobs that are similar and things like that. So getting into, I know we might have, in this organization, startups, very small contractors that are just getting going to ones that are doing hundreds of millions of dollars in revenue. And so this might not apply to you, but it could in the future. So a couple things to think about with your financial statements. Who's using them? Obviously, every single one of you is, as a management team and owners of the company, are using the financial statements to make decisions. As I mentioned, bonding is going to get, I think, more relevant with some contractors creating issues in this market. Other and now the subs are paying for that. not going to name names, but that there's going to be more risk, and which means that bonding becomes applicable, and for generals to protect themselves, owners to protect themselves. So we'll probably see more of it, and usually to get bonded, you're going to have a compilation or reviewed financial statement by a third-party CPA. I just got off the phone this morning with a small roofer, only doing about $9 million in revenue, and they just won, or trying to win, a couple school jobs to do the roofing there, and they've never had to be bonded before, never had a reviewed financial statement, and now they need a review, and they weren't doing any job costing, they weren't doing anything in their system, and now they've got to present a report of how their jobs are performing, and it's digging through years and years of data that have never been broken out to be able to see how they're really performing job by job, and if they're recognizing revenue properly and things like that. And so they're about a year behind, 2 years behind of when they should have been thinking about that, and now they're kind of in a bind trying to sort that all out. And so this last bullet point, do you need this? It depends where you're at, who's asking for your financial statements. Most of the time, companies in your situation aren't going to need an audit, but a compilation review could be in the cards. And if you have questions on that, please reach out. All right. So actually some more interesting, I would say, information that should be very relevant to everyone. Every year for
24 years.
Yeah, we've been putting together a survey, our firm, by taking data from our clients and non-clients and any contractor that will participate. And just within the last few years have partnered with the AGC. And so we've blasted out an email to the percentage of participants. This doesn't sound great, but we've invited over 1,200 contractors to participate in this survey this last year, and 85 did, or 84, and so it actually is good data. So if you didn't get that email and would like to participate, again, we can get you set up on that for this coming year.
Thanks to Dave, we've got probably at least 10 of those are plumbers.
I think more than that even, yes. So yeah, appreciate that. So the information is in 2023. It came out in September. The different participants, I can't read this, fortunately I don't have this all memorized, but a good mix of large contractors and smaller. About 50% of the companies that participated have between 1 and 50 employees, and so and obviously the median reflects that. Ranging anywhere from a couple million in revenue up to over 500 million. So various questions, hundreds of questions in this survey, and a lot of them deal with salaries and benefits, but a few others deal with forecasts and things like that. So I liked this one, the optimism that we still have going into 2024, but of what are people seeing with their revenue forecasts, and 50% are expecting an increase in this. 50% are increase, 19% are expecting a significant increase. So there's a lot of good things still going on, especially here in Utah in the construction industry. So employment within the state, we have 138,000 construction, anywhere from laborers up to owners of construction companies that are within the industry. That has increased by 20% since 2020. where the nation only increased by 5% during that same period. So, yeah, before. So in the last, 4 years, we've increased 20% and well above the national average. 2022 did slow down a little bit. And then, not necessarily the construction specific, but this data point is interesting that, in years past, our population growth is from, having kids. Our families have been, growing, but there's been a major change there, and our growth now is mostly due to, or 61% is due to migration from other states. And it'd be interesting, obviously we're not really doing a Q&A, but our contractors seeing that with, who you're hiring, are there people willing to move here? Are you seeing, new laborers show up that haven't been here in the past and have worked in other states? And yeah, it'd be interesting to think through that. Okay, so this graph is very interesting. For the first time in, ever, it seems like we don't have data before 2001, but there are more job openings than people were hired, for the first time in that many years, and it's by a lot. And so this is tough because we can't fill our positions. There's just not enough people to do it, and getting creative, and that's why we do this survey, is to help all the contractors be able to know, are we paying our people right? What ways can we make them stay and make sure that they're valued in our organization and not be looking for something else. So 85% of contractors say that they have openings, 88% say it's difficult. I don't think these are surprises to anybody. 68% say candidates are not qualified to work in the industry. That's a tough one, and I think this organization, the AGC, others are trying to combat that with, having training programs and things like that to those that come in unqualified. Well, let's get them trained and up to speed, because we kind of have no other choice. And labor availability still is top on the list.
That probably mirrors the accounting industry.
Yes. Literally, this is exactly what we're dealing with. So, all right. So changes in compensation from 2023, 2021 and 2022 to 2022 to 2023. So both range periods, base compensation increased about 5%. The big jump in total compensation packages that you're going to see on that 2023 column is bonuses. There was just companies were doing well, and they were willing to to keep people. They had to pay bigger bonuses. So that kind of explains that large increase. I don't know if it's somewhere in here. I think maybe later on. If not, I just mention it now that in the survey it was asked, well, what do you expect to be paying in 2024 as an increase? And I think it was about 4%. It was a little bit less. People were going to pull back a little bit. Okay, so of the survey, again, these are kind of higher level positions, but some of the larger increases in salary from 2022 to 2023 are listed here on this table. The next, I'd like the bottom two, at least point out those two. I think business development director, again, you as probably the owners or those in this room are probably, they have multiple hats. You maybe not have these specific positions, especially if you're smaller, but business development is always very important. If we're not bringing in more work, then how are we going to stay in business, keep our people busy? So, and then the last one, we've seen construction is targeted more than any other industry with cyber attacks, ransomware. I mean, multiple clients this year had issues with that, and we are seeing companies starting to invest in protecting themselves a bit more. IT manager having somebody that's that's making sure that you're protected and your data is protected and your finances are protected. Now getting down to more, labor type positions and ones that are more applicable. You look right there in the middle, plumber apprentice wages increased 16% from 2022 to 2023. And then you can look at a couple more of those that might apply. Project managers was depending on the level of experience and the types of jobs that those project managers were over, kind of drove their increases. All right, so overall salaries increased about 6%. I'm glad my memory is still somewhat intact. We expect 2024 to be about 4% across the board. Obviously, that's going to depend on what level of position, how valuable they are, how desperate we are to keep them, and so it could be a lot higher in some cases. And we asked, the question, why are people getting raises? What are driving? Do people have specific, bonus? What I'm trying to say, goals that they have to hit to be able to get, a bonus, or is it all discretionary based off of, the income and revenue of the year? It was kind of all across the board, but some of the more common answers were what they were increasing it because costs are increasing, and we kind of have to try and keep up with that. Then comparing it to our competitors. So we found out that so-and-so is getting paid down the street this much. Yeah, we're going to have to pay our guys something similar, or they're going to jump ship. And then achievements, how well they're performing was the other big one. All right, so this graph talks about staffing changes. Over 60% expect to see, some increase in having to hire more. Very, very few expect to have to, let people go or decrease their workforce, which is positive. It's great. That means there's a lot of work out there, but it also is a huge challenge to fill all those roles. Okay, some other miscellaneous items from this survey that we thought were important to at least bring up. Really like this first one. I don't like the number on it, but I like talking about it because it's important. Only 36% of companies are I think it's the opposite, and I apologize for that. I think it's 36% are paying referral bonuses for helping the recruiting effort. Our firm has implemented a great program where we can, depending on the level of position, if I go and recruit another, manager, tax manager, we'll say, from another, firm or something, then I get a pretty hefty bonus, or a referral bonus for doing that. And
it's like $7,000.
Yeah. And so, what it does is it spreads out the recruiting effort among everybody, and everyone has that responsibility to make sure we're finding top talent and then compensating them for it. Turnover range from 24 to 44%. I honestly thought it would be a little bit higher than that. We've seen higher numbers than that with our own clients, especially at the lower level positions, which can be a challenge. Only 32% are involved with technical education programs. We got to get that.
Right here.
Big plug for Dave. We got to get more people involved in that, and making sure that they're getting trained and getting the technical skills that they need. Number one, to help our businesses succeed, and as they feel more comfortable in their position and can grow, they're going to stay along and keep it as a career, not decide to do something different. And then very few contractors have said that they have, behavioral or health benefits for their employees, and that we're seeing that, the wellness and mental health of our employees is becoming more and more important, and making sure that there's benefits out there for them to take care of themselves and their families. Okay, so I think we've kind of touched on these, but in summary, pretty much everyone believed that finding and hiring qualified employees was the biggest challenge. Some of the other challenges that the contractors in Utah are seeing are delayed or canceled projects. Hopefully, with COVID in the rearview mirror, a lot of that is past us, but we're seeing other challenges with interest rates and developers and owners having struggled getting funding. We're still seeing some delays that can create issues, losing talent, training our employees, and cost of living. So just we'll hurry through this. CLA has a team where we help find talent for our clients, specifically in the construction industry, anywhere from office staff, CFO, controller, to project managers, superintendents, and that. And I had talked to one of our main guys over that department when this survey came out, and some of the points that as he speaks with contractors, helping them find their people, what are some of the issues that they're discussing with him. And obviously there's just not a bunch of talent out there, as we've talked about with these survey results. A lot have left the industry or retired. There is a lot of going back to that graph where there's so many more openings than actually people getting hired. They might have five job opportunities, and what's the chance of us getting them? We got to really stand out to be able to get them. And so there's just a lot more opportunities out there. And then yeah, so let's see, last couple slides here. So he talks to them, what are they looking for? And I think we know the answers to these, and there's never really perfect answers to them. They want work-life balance. He's shocked of how many construction jobs people want to work hybrid or remote, and it's like, how does that even work? It's obviously the laborers out in the field have to be on site, but that's been tough, especially in our industry as well. They just want to get paid a lot, and then having unique benefit packages, something that stands out to them that they aren't getting offered somewhere else. So the companies that are able to get good people, some of the good things that they're doing are making the interview process very quick and easy. I know that sometimes is tough, especially if we're filling a very important position, but the longer it draws out, the more likely they're going to find another opportunity during that. Be flexible, willing to train them, paying them well, and knowing that the market's changed. We can't be paying what we were 5-10 years ago. And then there's a few of the positions that are hard to fill because they're important positions. Steve, anything you want to add on that survey section?
Yeah, and so, yeah, that pretty much sums it up. If you're interested in a copy of the survey, just email one of us and we'll send it over to you. I mean, it came out, like I said, I think in November. So, I mean, the information is a few months old, but it's still got some valuable stuff. It was done by a engineering firm out of Denver, executed the actual survey. And I mean, I don't know how many pages, but there's probably 30 or 40 different classifications. It's really good, of which there's probably a few for plumbers. So take a look at it. Let us know if you're interested. We'll send it out to you free of charge. And Dave, I think I already gave you a copy, maybe not. I'll get you a copy. So, okay. So there you have it. And again, thank you for your time. And we're happy to be a member of the Plumbing Association. Yes, sir.
If there are any questions online,
Yeah.
you'll unmute. I'd be happy to relay those questions.
I got one, Steve.
Yes, sir.
You told me that on the ERC that they bumped it up to 6 years on the audit period, the window.
Yeah, that's right.
You had 5 on your slide.
Oh, did I?
So
Okay.
You mentioned that
Okay.
to go back and amend your return, you only got 3 years.
Right.
On that tax that you paid on it, if you send it back, you gotta get the amended return done within the 3-year period.
Yes.
Steve, could you repeat that?
Okay, yeah. Jeff was just asking about the timing of and it is, for the ERC, it's a 6-year audit period from 2021. I think maybe from the end of 2021. So what I think I was implying is that it's 5 more years or a little less than 5 years now. But that, where was I going here with the,
Just to give an example,
yeah.
this scenario, why this is an issue is, let's say the IRS doesn't pick yours up to audit for a couple more years, and they disqualify it, disallow it. You got to pay all that money back, penalties and interest, and now the statute of limitations to be able to go back and amend your return and all of that is now closed, and you paid taxes on it, and now you can't go amend that return and get those taxes back. And so it's just a perfect storm. It's super big risk to the company, and you know, these firms that have been just having you fill out a questionnaire and saying, yeah, you qualify. I mean, if that's all that happened, I would say you got a few days to look into that. So.
Well, continue. I mean, you can, this deadline for the 80% payback thing is through next Friday, the 22nd. So if you don't make it, I guess worst case is you could amend your payroll tax return and pay it back, but you'd have to pay 100% of it back. And you probably get penalties and interest on that as well. But so you got a week and a half to figure that out. But I suggest you ask whoever helped you with your program to send you the support for your qualification. And many of them are not going to be able to do that.